Inventory in the Phoenix area keeps rising. Can we sustain this? What are we actually looking at here? We're going to talk about that today on what's going on in the Phoenix real estate market. We're also talking about all of these crazy swings in the market, how that's affecting mortgage rates, and of course, real estate. So let's get into it. Thanks for joining me on this Wednesday. The Cromford Report has some really interesting information. They're breaking down the days of inventory, looking at those long-term averages by price range and where we stand today to really put into perspective how our inventory has grown and whether or not it's something we should be concerned about. So they're first breaking down the bottom end of the market. So homes that are priced under 300,000. And you can see on this graph that the long-term average is 50.5 days of inventory. If we look at where we're at today, it's 146.6. So inventory has grown significantly in this price range over time. You can start to see, obviously back in 2020, everything was just super low. Into 2022, we saw some growth. We saw another dip. Then we saw some pretty big growth in inventory under 300,000 starting in 2023, and it's since climbed to where we're at today at 146.6 days of inventory. Now, how does this affect you if you're a buyer? Well, the world is your oyster. You have lots to choose from, but if you're a seller trying to sell a property under 300,000, you're up for kind of a big challenge at this point because there is so much inventory, and oftentimes inventory at this price is either older or it's some sort of condo townhome, which usually has an HOA, which has an additional fee. So those can be some hurdles for buyers in obtaining a loan that will approve either a condo townhome if they're not getting a conventional loan, and even sometimes if they are, or if the condition of the property is not as great because it is an older home. So some challenges if you're trying to sell something under 300,000 right now, just know what that inventory landscape looks like. Now, when they break down the price range between 300,000 to $1 million, this is kind of the mid-range of our market. We see that the long-term average is 94 days of inventory. And today we're sitting at 106.7 days of inventory. So higher, once again, what we're seeing today than the long-term average. Same trend where everything was fairly low through 2022. We saw a spike, a little dip in 2023, and then began to see the inventory rise from there. So in the mid-range of the market, we're certainly seeing an increase in inventory, but it's not quite as drastic as what we're seeing in that low end under 300,000. Now, what is behaving totally different is the luxury market, and I've mentioned this in the past. The luxury market, which is priced between $1 million to $5 million, has inventory lower than the long-term average. So complete opposite of what we're seeing in the other price ranges. The long-term average is 279.4 days of inventory. We're sitting at 169.5 right now. Now you can see again, same trend. It was much lower during the pandemic. We have seen an increase since then, but it just hasn't climbed to the heights that the inventory levels have in the other price ranges. Now, the question is all of the volatility with the stock market going to affect the luxury market? Because typically we see that any volatility in the stock market or uncertainty tends to affect luxury first, just because that is what those types of buyers are paying attention to. That may be where a lot of their money lies. And so remains to be seen if that is going to have an effect on luxury. But right now, luxury is actually fairly competitive. Inventory is staying fairly low. The demand is still there, and it's not really rate dependent because most buyers in the luxury market are actually paying cash. So if you're a seller and you're just curious what the inventory looks like in your city, check the description below. I have a link where you can request that information. So I thought that was really interesting to look at to see where we're at with days of inventory in all of these different price ranges. And if we look at our active listings on the market, we're seeing again that same trend of active listings climbing. In fact, between last week and this week, we saw a pretty big jump in active listings. We're now sitting at about 26,000 active listings on the market. Last year at this time, we were only at about 17,000, somewhere around there. The year before, we were at only 13,000. So obviously a very big change even in the last 2 years when we look at our active listings on the market. We're also going to take a look at new listings added by month, so we'll get into that in a little bit. I wanted to share this information from Redfin. Homebuyer demand improved last week, but tariff turmoil, rising rates, and economic jitters likely to hamper sales. If you've been paying attention to the market at all, you know that it is kind of hard to track because within 10 minutes, something could have changed drastically. So they're saying home buying demand improved at the start of April. Mortgage purchase applications rose 9% during the week ending April 4th on a seasonally adjusted basis. But they say those numbers reflect what happened before and in the immediate aftermath of last week's initial tariff announcement when mortgage rates dipped to a 6-month low and gave homebuyers a brief reprieve. Now, this article was written on April 10th, so this was last week, and then they're referencing the week before that. The improvement in demand is unlikely to last, and they're probably right here because we have seen rates do so much more since this article was written. Mortgage rates have since soared, jumping on April 9th to 6.95%, their highest level in 6 weeks. And I can tell you it didn't end there. We're going to take a look at where mortgage rates are at today and what's been going on with them. Home buyers need to earn over $50,000 more than renters to afford monthly payments, and the gap is widening. So we hear this argument all the time that renting is cheaper than buying, and in many areas it is. It's just really a matter of if you want to invest in an asset for the future and spend your money there, or if you want to pay rent over time and not really see something back from that. It also depends on your situation financially, how long you plan to be in the home. So there's a lot of arguments to be made for renting versus buying. But if we're just looking at the monthly payment, yes, renting is cheaper in most areas right now. They're saying Americans need an annual income of $117,000 to afford the typical home for sale. Now, what you need to remember is typically when home buyers are buying, or the majority of home buyers, it's a dual income household. It's two people coming together and being able to afford in that way. Now, of course, there are single home buyers or families that have a single income. So that does exist. But oftentimes we are seeing two incomes, which is what is making this $117,000 still somewhat affordable to some people out there. But they're saying that's 82% more than they need for the typical rental and up 73% from last year. The gap is widening because home prices are rising faster than rents. Now, it's not just the home prices, but also we know that mortgage rates have not been very friendly to buyers in a while. In fact, the last few weeks has looked a little bit ugly. So when you add in what those rates look like, it really changes that mortgage payment and it really makes rentals look much more appealing on a monthly basis. So what has been going on in markets over the last few weeks with all of this news coming out, all of this volatility? Well, this article from Yahoo Finance says low mortgage rates from tariff pain, don't count on it. Mortgage rates swung wildly on Monday and more movement may be on the way. For a moment, it looked like the tariff-driven stock market crash would have a silver lining for anxious home buyers. Their stock portfolios may be decimated, but at least their mortgage rates would fall. And so we did see that with the tariff announcements almost 2 weeks ago and saw mortgage rates react to that, come down significantly to some of the lowest levels we've seen in months. However, that was very short-lived. Treasury yields and mortgage rates skyrocketed higher on Monday and continued to climb on Tuesday. They're referencing last week. Average 30-year mortgage rates swung nearly 30 basis points over the course of the day to 6.82%, according to Mortgage News Daily, mirroring an uptick in 10-year Treasury yields, which rose 19 basis points to 4.18%. Mortgage rates are moving higher now precisely because of their close relationship with the 10-year Treasury yields. Those yields continued to climb, mostly on Tuesday morning, again referencing last week, completely wiping out their decline. Mortgage rates inched up too, averaging 6.85% by midday Tuesday. So last week we saw a total reversal in what we had seen in the week before and actually ended the week last Friday with rates over 7%. So you can see this big jump that we had last week. And then finally on Friday, on the 11th, we were at 7.07%. Since then, Monday, it came down to 6.98%. I'm recording this on on Tuesday, so we don't have too much data for that yet. But that is how we ended last week and have begun this week. Again, this big drop here being that initial announcement about tariffs, and then everything has kind of overcorrected since then. According to one of my lender partners, they're saying with all the ongoing drama and rapid policy shifts, don't be surprised if we see continued volatility in the foreseeable future. So buyers just know that a rate you get today may not be the rate that you're able to get once you're actually under contract. There is a lot of movement in rates right now. And for sellers, know that buyers are somewhat hesitant because of this information right now. They are seeing a very big change in their payment depending on what the rate looks like. And they may be a little bit hesitant, not only for that reason, but just volatility in the stock market overall to make a move. So I would anticipate that we will see purchase applications and showings and all of that kind of thing probably going down a little bit over the next few weeks. Now, according to Mortgage News Daily, they say things are getting off to a friendlier start in the present week with the 30-year fixed rate index edging back below 7%. As is true with most markets at the moment, the bond market, which underlies the mortgage rate movement, continues a general pattern of reacting to developments on tariffs and fiscal policy. Friday evening's updates on tariff exclusions for certain tech-related imports helped bonds set up for today's lower rates. So everything is really fluid right now. Any announcement that comes from the government related to tariffs, trade wars, all of these things are affecting how mortgage rates basically react. And so you really have to keep an eye on things. If you are in the middle of a transaction right now, just make sure you're talking with your lender. You know what rate you're locked into if you're able to lock in. And as a seller, just know that buyers might be a little bit hesitant right now with all of the volatility. Now, of course, if you're trying to avoid today's rates altogether, I've talked about assumable mortgages. Those are certainly something that you can find out there in the market right now. It takes a little bit of digging, but it's definitely possible. So check the description below. I have a link where you can get more information and a list of homes with assumable mortgages. Now, we talked about our active listings earlier. Let's take a look at what's going on with listings under contract and the listing success rate for sellers that are on the market right now. Before we get there, if any of this is helpful for you, consider subscribing or share it with someone who might find it interesting. I would appreciate that, and we'd love if you'd be part of our community moving forward. So listings under contract, here we are again, keeping pace with where we were at last year, which is great until we realize that we actually have more listings on the market now than we did last year. But we are still seeing contract activity fairly steady. In fact, we did see buyer demand go up just slightly in the Cromford Market Index, so I will share that with you in just a moment. The listing success rate is sitting at 71%. And you can see we saw this little dip here in April as compared to March when it was at 74%. This is basically the percentage of sellers who actually successfully close a listing once it's been on the market. If you see here, back in December of 2022, we hit a lower rate than we've seen in a very long time. We've since recovered from there, but just in December of 2024, we were at 67%, not too much higher than where we were at this low. And it appears that we may be heading back down again. So this will be something to watch, something to keep in mind as you are thinking about selling your home, that the market is very price sensitive. Unless you are in that luxury market, like I shared with the lower days of inventory, much of the market is very price sensitive right now. So it really is in your best interest to be pricing competitively from the start. Now, if we look at new listings by month, we've been tracking this every month of the year so far, and every month we have beat the number of new listings added to the market than we had the last 2 years. Where we're trending this year so far is 4,699 in April. Last year, we added 8,893. So we're on track, on pace with that, probably pacing a little bit faster than we were last year. So we'll see. Again, I would expect new listings this month to probably outpace what we saw the last 2 years as well. Now let's take a look at the CMI. We are at 78.8, technically in a buyer's market throughout the valley. Demand 81.5. So demand has come up just slightly because we were in the 70s for a long time. Not seeing a big change here. And again, I'd probably expect to see this start to go down after all of the volatility we've seen over the last couple weeks, but we will see. Supply at 103.4. That continues to increase as we've been looking at that active listing and new listing counts. So not surprising there. If we take a look at every major city and their respective CMIs, again, we're seeing a lot of red arrows here. Only one city who had a big change in a positive direction, which was Avondale at 12% month over month. Chandler is still our strongest sellers market, albeit getting weaker every time we look at this. It's went down 3% from last month. When I say it went down 3%, the CMI did, the change in the CMI, not prices or anything like that. So it just lost some advantage for sellers in Chandler. We also have Paradise Valley, Scottsdale, Fountain Hills, and Phoenix, and Glendale, and barely Gilbert, all hanging on to a seller's market. Most of those seeing some deterioration away from a seller's market. And then we've got our buyer's markets like Maricopa, Buckeye, Queen Creek, Surprise, Goodyear. If you have a listing in any of those cities, you're likely not seeing a lot of activity on it, and that's okay. It's probably going to take a while to sell. You'll likely get an offer that has concessions that's probably under list price, and that's just the market conditions that we're in those cities. The overall change month over month on this was actually negative 2.9%. And compared to last week, the month over month change was negative 3%. So we had been seeing some acceleration away from a seller's market. That's been, I think, 3 weeks. This is the first week that the trend actually reversed, albeit, extremely minimal. So it's really nothing to take note of. But I did want to mention that because maybe this will become the next trend. We will see what happens from here. Now, when we look at the contract ratio, where we stand for the market overall is 36.5. And 36.5 is considered that warm, balanced market. And so right here, warm and balance in green. Oh, it looks like they got their map updated now, so we can actually see everything on here again. So we got a lot of green, which is warm and balanced. We have a few zip codes that are yellow. We've got Tolleson at 85353, 85043 in Phoenix, Glendale, Phoenix, some North Phoenix zip codes, and then one zip code in El Mirage, all more in kind of the hotter realm. But keep in mind, this is really basing that on the number of active listings on the market and how many are actually under contract. And so it's really measuring how many options buyers actually have in those areas. So with Glendale, 54 are active and 41 are under contract. So there's actually not a lot available in that zip code of Glendale, which is what makes it a little bit hotter. Now, if you've been considering selling and of course, hearing this information and not being too excited about that, I can totally understand. If you want just an instant home value to get an idea of what your home could potentially list for, check the description below. I have a link where you could check that out. And don't forget to request the inventory in your area because that could be helpful information for you as well as you prepare to sell. We'll see what happens over the next week. It could be another wild ride with everything going on in the economy right now, but I will see you guys next Wednesday on my next market update.